Hey, it's Nick Funditis at Royal LePage Performance Realty, and I'm answering a question from Reddit. Today's question is from a first-time home buyer user, Prash HRC or Prash RC. He's located in Mississauga, Ontario, and he has recently purchased his first property. It's a condo. Bought it for 500,000, put 100,000 down. It was so 20%, and now he has found out that he has a little bit extra each month to that he could deploy towards various things, and he's has questions about what to do with it. So, first question is whether it's better to pay off the mortgage or to hold some of that money in savings and potentially with the idea of purchasing an income property, or if he does decide to pay off his mortgage more aggressively and refinance at a later stage, what does that mean? What can he pull out of his property? Is he going to need a whole other mortgage on his property? What's needed? So my answer here is just that there are a few factors that go into what the right answer is, and I'm saying that the right answer in this case is just what has the OP get the most wealth in the long run. Uh, but to make sure that I've got this right, because I'm a realtor, I'm not a lender, although we do see this stuff all the time. I asked a colleague of mine, Kristen Stouffer, she's a mortgage broker over at Dominion Lending, to fact check and to bounce these ideas off of me. So number one is just if you pay down your mortgage aggressively now, it's a great choice if number one, you feel that the value of your home is going to be stable or go up over time. Since you live in Mississauga, there's a good chance that's going to happen. Also, that your life situation, so your income, whether you're going to have to move, you're not going to be in a situation where you get, like if you're military and you got redeployed, or if you were, at risk of a job loss or something like that, that you might be without income suddenly. You don't want to put yourself in a situation where it's tied up in your house. It's harder to access when you need it. It's not as liquid. But if you do, you are in a stable situation where you can put it towards your mortgage, and assuming you don't have higher percentage debts, so say like credit card debts or things that are up over that 6% you're paying on your mortgage, that you should pay first to get rid of those, because those are eating away at your wealth faster than your mortgage is. Then it does make some sense to put at least some of your savings towards your mortgage, because the faster that you can pay that down, it helps you pay off the mortgage faster. It also means that you're not spending as much on interest, because you're taking money and you're putting it towards the principal above and beyond the regular schedule of payments for your mortgage. And just go talk to your current lender or talk to Kristen or whoever, and they can show you just how fast, like what a big difference early in your mortgage, paying even 500 or 200 or 1,000, here and there when you can afford to do it, makes such a huge difference on your mortgage and the schedule of payments. Now, the second question you had there, if you refinance at a later date because you do want to purchase an income property, then yes, you are generally going to be able to use a good portion of the equity on your current home, and that would include three things. So the money you can then pull out is probably going to basically be all of the extra savings that you've contributed, because those are part of your principal that you've paid down and you've added. You can probably, depending on your mortgage, pull at least some part of your down payment, because you might be able to take that 20% you paid down and reduce it to a lower percentage if your mortgage allows. And then any new equity that you've built by the increase in value of your home. So if your home, when you decide to buy an income property, has gone from $500 in value to the list price would be $600 in value, or the price it would be assessed at by a lender anyways, you've made $100,000 that you can pull out and you can use to put towards your income property. So yes, this is generally in the form of a new loan. However, if you refinance it with your existing lender, hopefully at a better rate than today's rates of 6% or whatever you've got it at, there's a very good chance that you can do this without penalty. If you want to explore different lenders, ask a mortgage broker, ask Kristen, whoever you're comfortable with, and that will help you find out the situation that's right for you. There are moving variables, but in short, if your job is stable and you see some growth value in your current place, then yes, it makes sense to be aggressive in the payment of your mortgage, whether or not you're buying an income property. And if you are buying an income property, don't worry that that's not going to hurt you from buying it down the road. In fact, it can help you a little bit because you've changed your debt service ratio. You've changed how much debt you're carrying. So for source for that, I'm a realtor in Ottawa, Ontario. We have clients that do stuff like this all the time. Kristen Stouffer, who fact checked for me, she's over at Dominion Lending up here as well. She's excellent. And we try and answer stuff on Reddit. I mean, every once a week or so, because Reddit is such a good resource for us. Just in all walks of life, we like to see if we can be helpful there too. Have a good one. Let us know what you do. Let us know how it goes, because I always think that's interesting to hear the follow-up. And take care. Bye for now.